Welcome to Breaking News to Trading Moves. We are looking at a specific automotive headline today and taking it straight into the financial mechanics.
Right. Our mission here is to examine a specific event and clearly lay out the market winners and losers associated with that news.
Exactly. I mean, you have a single piece of hardware that fails, maybe a bad lens or a faulty connection, and suddenly capital is rotating across entirely different sectors.
Yeah, we're laying out the direct path a single mechanical failure takes as it travels through the market ecosystem.
So let's just lay out the facts right away. What is the headline we're looking at?
The facts are very straightforward. General Motors is recalling 271,770 vehicles in the U.S., and this specifically affects Chevrolet Malibu sedans.
Right, and the National Highway Traffic Safety Administration noted this is a rearview camera issue.
Yeah, this hardware problem.
Right, like the screen inside the cabin might show a distorted image or, it could just go entirely blank when you put the car in reverse. To fix it, dealers have to physically inspect these vehicles and replace the camera unit.
Which brings vehicle quality, supplier exposure, and recall-related costs directly back into focus. A headline about 250,000 vehicles needing physical hardware replaced. It immediately prompts traders to evaluate the financial burden.
Well, yeah, because the immediate market reaction usually begins right at the top of the chain.
Exactly. Moving directly from the headline, you start by looking at the manufacturer and their direct supply chain. This is really where the first group of losers emerges.
Because when a recall of this size hits a major U.S. automaker, investors tend to reprice quality control risk across the broader legacy auto space, right?
Right. The market looks at the headline and grows cautious. Even if this rear-view camera issue is completely specific to General Motors, the financial algorithms, and the analysts sitting at their desks start running models on the entire sector's manufacturing standards.
That puts major legacy automakers straight into the crosshairs. So we have affected automakers facing scrutiny like General Motors, ticker GM. There's Ford, ticker F, and Stellantis, ticker STLA.
Yeah, they all get dragged into the conversation.
I always think about this reaction like finding a severe flaw in the steel framing of one house on a block.
Oh, yeah, that's a good way to look at it.
Suddenly you're wondering if the same builder cut corners on the others, even if they look flawless from the outside. But why does this specific caution matter right now?
Because these legacy automakers are operating in an environment characterized by incredibly tight margins.
Right.
They're already battling intense pressure from inflation and labor negotiations. Plus, they carry the massive financial burden of the electric vehicle transition.
Spending billions of dollars developing new platforms.
Exactly, while relying on the profitability of their traditional vehicles to fund that research. And finally, there are ongoing operational execution concerns across the industry. So balancing that many expensive variables makes a company's financial foundation sensitive.
So a recall involving over 270,000 vehicles is just an unexpected cost hitting a balance sheet that is already under pressure.
Right, it signals potential operational inefficiency.
So the automakers are basically walking a financial tightrope, but the automaker is just the final assembly point. We also have to look at the supplier ecosystem.
Oh, absolutely. A rear-view camera recall instantly puts a spotlight on the ecosystem behind in-car electronics.
Right, so we are looking at displays, internal wiring, vision systems.
The camera lenses themselves, the processing units. Modern vehicles are essentially rolling computers, so when a specific electronic component fails at this scale, market scrutiny extends well beyond the automaker.
Traders evaluate the supply chain to see who designed the parts, who manufactured them, and ultimately who might be on the hook financially for the replacements.
Because the automaker will frequently try to claw back the costs of a recall from the supplier if a defect is proven. And that puts supplier margins in jeopardy.
Wow. Okay, so the potential component losers in this scenario include major auto tech names. We have Aptiv, ticker APTV, Lear, ticker LEA, and Visteon, ticker VC.
Keep in mind, the automaker does not usually name the specific supplier responsible for the faulty cameras in the initial headline.
Right, they keep that quiet at first.
Yeah, but traders look at auto tech and cockpit electronics names as read-through plays. In the market, a read-through play means investors are drawing conclusions about an entire subsector based on the news from one specific event.
So if concerns build around component reliability, or if investors start modeling higher replacement costs for suppliers in general, these stocks face downward pressure.
Right. The market anticipates that automakers will demand stricter, much more costly testing protocols from their suppliers going forward, and those testing costs eat directly into supplier profit margins.
Okay, so let's trace the path of the car itself. It leaves the factory, it hits the road, the recall is announced, and the driver is told to bring the vehicle in for a fix.
Which takes us straight to the physical locations where these recalls are actually handled.
Right, the dealerships.
Hmm.
Which brings us to our second group of losers, the dealership and service networks.
Yeah, the physical reality of a recall plays out in the service bays of local dealerships. These recall headlines disrupt normal sales activity and create added service bay pressure.
Wait, I have a logical question about this. If dealerships get paid by the manufacturer to do warranty and recall work, shouldn't a completely booked, busy service bay be a good thing for them?
Well, it is a completely fair assumption, but the reality check reveals the operational downside.
Oh, really?
Yeah, warranty work, including recalls, typically pays a fixed, negotiated rate from the manufacturer to the dealership. And this rate is notoriously lower than what a dealership charges a regular customer for routine maintenance.
Ah, I see.
Furthermore, the automaker dictates exactly how long the repair should take. So if the manual says a camera replacement takes 1 hour, the mechanic gets paid for 1 hour, even if a stripped screw makes the job take 3 hours.
Wow. So while the service bays are full, they are filled with lower margin work.
Exactly. This creates severe operational bottlenecks. The mechanics are tied up replacing rearview cameras, meaning they cannot take in high-margin customer pay work like major engine repairs for other clients.
It clogs up the most profitable part of their entire service business. They are essentially turning away high-paying customers because their lifts are occupied by fixed-rate recall work.
And the downside extends beyond the garage itself. Customer hesitation on the sales floor is a real thing.
Right, negative headlines create hesitation.
Yeah. If a consumer walks into a dealership considering a brand new vehicle, and they see a waiting room packed with frustrated owners dealing with a recall, that creates softer sentiment around the brands involved.
So the operational headaches in the service bay and the negative showroom atmosphere often outweigh the short-term influx of warranty service traffic,
Absolutely.
which brings pressure onto the publicly traded dealership and after-sales service networks. We are talking about names like Penske Automotive, ticker PAG, AutoNation, ticker AAN, and Lithia Motors, ticker LAD.
Right. These companies operate massive physical footprints, so they bear the brunt of these operational bottlenecks across hundreds of locations simultaneously.
We have mapped out the downside across the supply chain and dealership networks. Now, let's pivot to the other side of the trade, looking at the companies that actively benefit when vehicle reliability becomes a major focal point.
Yeah, it's not all bad news for everyone.
Right, which brings us to our first group of winners, safety tech and the aftermarket.
When a recall is tied directly to driver visibility and safety hardware, like a rear-view camera that prevents backup accidents, it renews investor attention on a highly specialized sector of the tech world.
So we are looking at companies with heavy exposure to automotive testing, inspection, imaging, sensing, and safety systems.
Exactly. Markets rotate toward the names that help manufacturers improve compliance.
The winners in this space include Dover, ticker DOV, Honeywell, ticker HON, and Garmin, ticker GRMN.
Because these companies provide the industrial tools, the precision sensors, and the quality assurance software that automakers rely on.
Yeah.
When an automaker experiences a costly hardware failure, the immediate corporate response is to invest heavily in better testing and inspection protocols.
For future production lines.
Right. Investors know this. Capital flows into the companies that sell those exact inspection and sensing technologies.
Okay, so that covers the corporate manufacturing side. Let's bring in the everyday consumer aspect, the aftermarket angle.
Yeah, that's a big piece of this.
Any issue that increases mandatory vehicle inspections or just raises general maintenance awareness supports aftermarket parts and repair-related demand. I look at it like going to the dentist for a minor cavity.
How so?
Well, you only go in because you have a specific problem, but sitting in that chair makes you hyper-aware of your dental hygiene. You leave the office, and you immediately decide to buy a much better toothbrush and floss on the way home.
Oh, that's a great analogy. That perfectly captures consumer psychology.
Right. A recall prompts vehicle owners to focus heavily on their general upkeep and replacements.
Exactly. A recall notice forces a driver to take their car into a professional setting. Once the car is lifted in the service bay, the technician performs a multi-point inspection.
Right. They might point out that the tires are worn, the brake pads are thin.
Or the engine air filter needs replacing. And even if the customer declines to have the dealership do that extra work due to dealership pricing, the seed of awareness is planted. The customer realizes their car needs maintenance.
Which drives traffic straight to the collision repair and replacement demand names. We have companies like O'Reilly Automotive, ticker ORLY, AutoZone, ticker AZO, and Genuine Parts Company, ticker GPC.
Right. And keep in mind, these companies are not direct beneficiaries of the recall itself.
Right, the automaker is not buying replacement cameras from AutoZone.
Exactly. However, these aftermarket retailers gain critical investor attention because the overall consumer psychology has moved toward vehicle upkeep. When people hold on to their cars longer and focus on maintaining them rather than buying new ones, the retail auto parts sector sees a consistent increase in foot traffic and sales volume.
So traders anticipate this consumer behavior and allocate capital to these aftermarket stocks accordingly.
Yes, exactly.
Well, if consumers are hesitant about buying new models due to quality issues, their money still has to go somewhere, right?
Right, the demand for personal transportation remains constant, regardless of a bad headline.
This brings us to our next group of winners, alternative retailers.
Negative headlines around a major automaker can direct consumer attention toward used vehicles or alternative brands in the short term. Buying a vehicle is a massive financial commitment.
Right, so when a buyer reads that a major brand is recalling 250,000 sedans for failing cameras, they become naturally cautious.
Exactly. They might delay purchasing a brand new vehicle out of fear of first-year production bugs or untested electronic systems.
So their attention turns to vehicles with an established track record. The market identifies the used car and alternative vehicle retail plays as the winners here. We have Carvana, ticker CVNAA, and CarMax, ticker KMX.
These companies offer an alternative path for the cautious consumer. They specialize entirely in pre-owned inventory. A buyer might feel much more comfortable purchasing a 3-year-old vehicle where any factory defects have already been identified and resolved by the previous owner.
So the alternative retailers capitalize on the hesitation surrounding new car showrooms. Now, this brings us to a really compelling dynamic that we need to explicitly point out. I call it the Penske paradox.
Oh, right. This is a great point.
Earlier, we listed Penske Automotive, ticker PAG, as a loser in the dealership and service network category due to operational bottlenecks. But Penske Automotive, ticker PAG, also appears on our list as a winner in the alternative vehicle retail category.
Yeah, it's a dual reality.
How does a single company occupy both sides of this trade simultaneously?
Well, a company like Penske operates a massive, highly diversified automotive business. On one hand, they own vast networks of franchised new car dealerships. Those specific locations experience the exact operational bottlenecks we discussed earlier.
Right, service bays clogged with low-margin warranty work, administrative headaches, and cautious consumers avoiding the new car sales floor.
Exactly. In that specific regard, the stock faces downward pressure. But they also have an entirely different arm of the business.
Right, Penske also operates a vast footprint of used car supercenters and alternative retail locations.
Yes, they maintain an extensive inventory of pre-owned vehicles. If a buyer walks away from a new Chevrolet Malibu because of the recall headline, that same buyer might walk across town into a Penske used car center to buy a pre-owned vehicle instead.
So Penske simultaneously suffers from the mechanical inefficiencies of the recall at their franchised lots, while financially benefiting from the consumer pivot toward used inventory at their alternative retail lots.
Exactly. It acts as an internal hedge. Traders evaluating the stock have to weigh which side of the business will experience a greater financial impact from the news.
It perfectly illustrates how complex the market mechanics really are. I mean, a single rear-view camera failure does not just impact the company that bolted it onto the car.
Not at all.
It touches the parts supplier designing the electronics, the local mechanic turning the wrench, the safety tech developer building the inspection lasers, the auto parts store selling windshield wipers, and the used car salesman down the street. It is a complete financial ecosystem reacting to a single hardware issue.
And as vehicles become increasingly reliant on complex digital screens, intricate sensor arrays, and highly integrated electronic ecosystems, the probability of software and electronic hardware failures naturally increases.
That makes a lot of sense.
Mechanical parts used to be the primary point of failure, but today a blank screen is a massive safety hazard. So the final thought for you to mull over is this. Will the market reaction to electronic hardware failures become a more frequent, almost routine event for auto investors to navigate as cars become even more computerized?
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.